Hey everybody, this is RC Peck. My cold is lingering now. I'm past the worst part of it. Now I just have a cough and I'm probably back to 90%, but it's amazing that 10% is just holding on. The 10% of the cold just does not want to let go. I'm going to skip a longer introduction this morning and get to the content because there are a lot of extremes and a lot of things going on in the market that I want to make you aware of. Hey everybody, this is RC Peck and this is my weekend podcast. And my theme for this weekend is a year of extremes. We are not quite done with the first month, and man, are there a lot of extremes going on. What I want to start with first is how the S&P 500, how the U.S. stock market is digesting a lot of this extreme. Now, I'm not going to show every single extreme. I'm going to show two of them, though they are related. So the first thing I want to show you is just here is the price chart of the S&P 500. And you hear me often talk about green light mode, red light mode, yellow light mode. Well, yellow light mode is just kind of a cautious, like, hey, let's just be aware. We don't really need to pay attention too much when the market is in green light mode. It's just like, hey, the probability is high of protecting and growing your money when we're in green light mode. But it's good to just kind of wake up and be aware when we pop into yellow light mode. And so yellow light mode happens throughout a longer term green light. It's just kind of a, hey, we're doing some corrections. And as you can see, it kind of corrects every once in a while. And I call that yellow light mode. It's just to be aware. And yellow light mode by itself is not really something to make any financial decisions on. What's most important is how often we're hitting yellow light mode. And usually in a year, a typical year, we'll hit a yellow light mode phase 3 or 4 times. You know, they'll be spaced out because you normally have this kind of upward trending cosine wave with the market. And so for the most part, yellow light mode is just, okay, it's there. But when yellow light mode starts getting closer and closer as it is now, we're hitting yellow light mode in December, about 6 weeks ago, and then we just hit it about 3 weeks ago, and now we're in it again today. So as you look at the screen, you can see that the yellow light modes are increasing. And that's typical what happens before we move into red light mode. Now, I'm not saying we're going to move into red light mode in the next few weeks. It's more of a being aware of what's happening and being cautious. Now, the S&P 500 has to digest a lot of information. And the S&P and every other stock market is forward-looking. It does not look back. It does not look at today. It looks into the future 3, 6, 9 months and says, hey, are things getting better or are things getting worse? And as you see on the screen right now, it's not really saying better or worse. It's kind of digesting all this information and really deciding which way, which direction to move. Should it move out and upward or should it move out and downward? And that's really what the S&P is trying to figure out right now. And as you can see, as you look on this screen, this price chart, we have been in yellow light mode 3 times over the last 6 weeks. That is not common. So that means we need to be aware and be awake and just kind of recognize what's going on. Now, for all of you who have access to market probability, I will let you know when we turn or move into red light mode. I will signal that, and I will not wait for a weekend podcast. You'll get an intra-week alert from me that says what the signal is. But right now, it's just more of a being aware. Now, let's talk about some of the extremes. Here, we're looking at the yield on the 30-year U.S. Treasury. So this is the yield. So as this price goes down, the yield on the U.S. 30-year Treasury goes down. And as you can see on the screen, there is a blue horizontal line, and it touches the yield price in 2009 and again in 2012. So the yield really fell. It fell about 47% in 2008. Actually, it never touched 2009. It fell very hard, 47%, the yield did. And then the yield fell again another 47% between the end of 2011 to the middle of 2012. So let's not use words like extreme or violent, but there's 47% drops on the yield in the U.S. Treasury. This drop we're in right now, which is impressive, is not 47% yet. So it has another 6 percentage points to go to meet this same correction or the same fall that happened in 2008 and happened in 2011. But I will say the yield on the U.S. Treasury has never, ever, ever, ever on the history of the planet Earth been this low. And it's the little red dot down in the lower right corner. It is incredibly low. That is deflationary, and that's also concern. People are concerned. When people are concerned, they move their money into U.S. Treasuries, long-dated U.S. Treasuries first. And that's what's happening. This is absolutely just water falling down more and more each week. But again, we have not hit that huge 47% fall like we did in 2008 and between 2011 to 2012 yet. Not saying we have to, but most likely it will. The thing about being below this blue horizontal line is we are in uncharted territory. There is no point where the yield is wanting to get to or not, but it has absolutely broken below this low that was set in 2008 and 2012. So we could see a little bit more downward pressure. And just what's so interesting about this is with Europe now printing 60 billion euro and the Swiss franc getting de-pegged from the euro and Singapore lowering their currency value and Japan having been at this for about 2 years now, we really are in kind of a very volatile area here with currencies and even commodities. So this is something to be aware of, and the stock market is digesting this and trying to figure out what should it do. Now, the last time the 30-year Treasury fell by 47%, or the yield on the 30-year Treasury fell by 40%, the stock market was already falling. The stock market peaked, here let me put my cursor, it peaked right back here in 2007. So the stock market was falling way before the yield on the 30-year Treasury was falling. This is different now. The 30-year Treasury yield is falling much earlier, much earlier than the S&P 500. Doesn't mean the S&P has to fall, no, but the S&P is digesting this information and figuring out which direction to go. The next price chart, just for quick reference, is the yield on the 10-year Treasury. And you can see if you look at the lower right corner of this price chart, we are not at lifetime lows yet. Back in 2012, the yield on the 10-year Treasury was about 1.35. And we are not there yet. We probably will get there. It looks like it will probably happen. But what I want to point out is money is flowing faster into the 30-year than the 10-year, than the 7-year, than the 5-year, and so on. So when people are scared, they put their money in that those long-dated treasuries first, and that's in fact is what is happening. The last price chart I want to show you is oil. Specifically, I'm showing you the West Texas Intermediate crude price, and I have a little blue horizontal semi-transparent bar on the screen. As of me recording this for you, the price of West Texas crude is at $44 a barrel. $44 a barrel. And you can see if you look over here to the right side of the price chart, we are still above where I think oil wants to go. Now, once it gets in here, this is basically between about $35 to $40. Once it gets in here, we have to watch and see what it's going to do. Is it going to come right in here and keep falling through? I don't know if you saw that Iran, the energy secretary of Iran, came out and said we can handle $25 barrel of oil. I don't know if that's them just kind of pretending and saying we can handle what you throw at us, Saudi Arabia. But we could see it break through. But the place that oil wants to go is in this blue, thicker, transparent line here. And once it gets in here, then we want to see what's going on. But this is an extreme. Not as extreme as the 2008 fall in oil, which fell from 144 to 34. That was a $110 fall. We have not seen that ... yet. But I'm watching to watch what it looks like and looking for opportunities. But right now, really the takeaway is to stay cautious. Money is flowing into places where historically people put their money when they are concerned about the future, when they want to play a defensive role, and that means money is going into bonds, all types of bonds, but where the money is flowing the most is into U.S. government bonds, more than corporate bonds, more than municipal bonds. It's flowing into U.S. corporate bonds. So the takeaway is stay cautious. We are in extreme volatility. The stock market has been incredibly quiet in the sense that it's just kind of moving sideways right now. It's only 4 or 5% below its lifetime highs. So that's not a big move down when you see 30-year Treasury yield and 10-year Treasury yields absolutely collapsing and falling to, in some cases, lifetime lows, as well as oil falling incredibly hard, incredibly fast. So extreme volatility, and really time right now is to preserve capital and be patient to see what's happening. Hey everybody, this is just another step in securing your portfolio and your future. Until next time, this is RC Peck.